In trading, risk management is often reduced to numbers, position sizing, stop loss levels, exposure limits. These tools are important, but they describe only part of the risk equation. In real market conditions, risk is shaped not only by what decisions are made, but by how reliably those decisions are executed. Execution is frequently treated as back end infrastructure. In practice, execution quality is one of the most underestimated sources of hidden risk in trading. From a theoretical perspective, execution appears neutral, but live markets rarely behave like theoretical models. Execution introduces variables that directly affect outcomes, timing differences between decision and order placement, price changes during execution, partial fills, or delayed confirmations. Each of these variables alters the risk profile of a trade after the decision has already been made. This is why execution cannot be separated from risk management. It determines whether a predefined risk plan can actually be applied under live conditions. Execution delays are often measured in milliseconds, which makes them easy to dismiss. However, their impact is not linear. A delay creates uncertainty, calmness replaced by urgency, deviation from planned entry or exit levels, pressure to fix the trade manually. These reactions introduce behavioral risk. The longer or less predictable the execution process feels, the more likely traders are to intervene emotionally. Risk management assumes a stable link between decision and action. When that link weakens, discipline becomes harder to maintain. A noticeable gap between intent and execution leads to second guessing decisions. Premature exits, overcorrections during volatility. These are not strategic failures. They are responses to an environment where execution reliability cannot be taken for granted. Experienced traders increasingly view infrastructure as an extension of their strategy, not as a neutral tool. Execution quality affects consistency of trade outcomes, confidence in predefined risk limits, ability to remain inactive when no setup is present. In this context, infrastructure either supports disciplined behavior or actively works against it. Some platforms, including Taurus Acquisition, approach execution as a risk control mechanism rather than a speed race. The emphasis is placed on predictability and clarity instead of constant stimulation or exaggerated performance claims. This approach aligns execution with risk management rather than treating it as a separate technical layer. When trades deviate from expectations, the initial reaction is usually to adjust indicators. Entry criteria, stop placement. Execution rarely enters the diagnosis, even though it may be the underlying cause. As a result, traders attempt to fix strategic elements while the real issue remains structural. This misdiagnosis leads to unnecessary strategy changes and increased complexity. Reliable execution reduces cognitive load. When traders trust that orders behave as expected, they are less likely to monitor positions obsessively, interfere with trades mid process, react impulsively to short term fluctuations. In this sense, execution quality contributes directly to behavioral stability. Execution is not a technical afterthought, it is an active component of risk management that shapes both outcomes and behavior. In modern trading environments, where volatility and information flow are constant, risk is no longer defined solely by strategy parameters. It is defined by the interaction between decision making and infrastructure. Understanding execution as part of risk management allows traders and platforms alike to shift focus from promises and features toward what actually determines long term consistency, clarity, predictability, and behavioral control.